Ron Muhlenkamp, you are bullish on the big cap tech names, names like Microsoft and Intel. These stocks have had momentum of late. Can they keep it up?
Yes, we think so. First of all, we like the balance sheets. The balance sheets are rock solid. We like free cash flows. They're generating cash very nicely. We think they got incredibly cheap when Europe probably had to sell them down. So they've moved up some, yes, but we still find great value there.
A more controversial play is the fact that you like the big name banks, the money center banks as well, names like JP Morgan and Citigroup and PNC. Now, some of these passed their stress tests. Citigroup had a little problem. Tell me, you're going to stick with these?
Yes. We've been telling people for 2 or 3 years that the American banks were on the mend. And we think that when Europe passed the LTRO, they kicked the can down the road a couple months instead of a few days or a couple weeks. So we think that if you're an American-based bank and you're competing internationally, like JPM and Citigroup do, you're probably facing you're going to get less competition from the Barclays and the UBSs of the world than it would have been a year or two ago. So as they pull back, we think there's ample room for these to run. But our trigger was when Europe passed the LTRO. So late last year, we bought into JP Morgan and Citigroup, and we own PNC. We also own State Street.
You also own United Health and Pfizer in your fund. You're bullish on these two names. Now, is that wise when there's all this talk about Obamacare? And that's still hasn't been decided yet. The court's going to decide on it now.
Well, that's right. First of all, again, they have great balance sheets. They've got great free cash flows. It's going to be pretty hard to do anything in healthcare without including a Pfizer or United Health. And if you go back and check a little bit, you'll find the prior great time to buy big pharma was when we were talking about Hillary Care. So right now, Obamacare is in. We think that the election in November is hugely important for the United States. And frankly, I'm being cautious on going out too far out on a limb, particularly on balance sheets. We own bigger, broader stuff than I ever really have. One, because it's cheaper, and two, because I want good balance sheets in here. But if Obamacare should get pulled back, these kinds of things will get a big pop. The fact that Obamacare is now in, and they've already absorbed all that.
Finally, those are 3 sectors you're bullish on. Anything you would sell here, what would you short?
Bonds. We own no bonds, particularly treasuries. The Fed not only has their thumb on the scale, they've got their whole arm on the scale. And as you know, real interest rates are now negative. Interest rates on treasuries are below inflation. That should not sustain itself. So, and you know, low interest rates are killing seniors. Low interest rates are killing pension funds, which we're starting to hear from. We just heard that CalPERS lowered their actuarial assumption. So the argument is that low interest rates help the economy. Well, that's not so sure if you're trying to live off those interest rates, either as seniors or pension funds. So yes, we own no bonds. If you want to short something, go shopping in the bond market.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to